Welcome to the Clear Path to Retirement with 𝗂𝗍𝗄𝗃 of ClearPath Wealth Advisors. I'm your host, 𝘵ike Spangle. Corey, how are you doing again today?
I'm great. Thank you very much.
So much fun when we do these programs. We talk about retirement planning. At least we like to have fun with it.
Yes.
We are looking forward to these years when we get to retire ourselves, but this is what you help people with in your offices. Every single day. You get to see the smiles on their faces, help them get to their own retirements. Although sometimes there is a lot of work that's involved with it as well. But you enjoy seeing people in your offices, right?
We love it. We love to get the chance to connect with folks, see what they're doing, because everybody brings a different perspective of life, relationships, and what they want to have happen. So I get to learn a lot, which is really fun. And
well, speaking of learning, you want to talk today about education, and that you do provide a lot of that. One of the areas, though, that I think is really hard to educate anybody on, not their own fault, is fees. And there are all kinds of fees in this industry, and I'm actually quite surprised that you're willing to pull back the curtain today and actually talk about those.
Sure. I think it's really important. Again, we've talked a lot, beating the same drum about education, and I really want you to understand how things work. Now, we don't have to go, these 30 funds or these 30 investments are inside of this fund, but I want you to understand what you have and how it works. And I think what's interesting, if we just spend most of the day just talking about mutual funds, because this is what most of us have. We think of investments, a lot of people think to stocks, but what's in your 401k? Mutual funds. What's in the account you've got at Fidelity or Vanguard or something like that? Mutual funds. And they're great, right? They have risk, they have expectations, professionals are doing all the work. The problem is that what a lot of people don't understand is there are things behind the scenes. They're not nefarious, right? They're not bad things, but there are these little things that have to make your money work harder, and some of those things are fees.
Right, right. So in those fees, though, all right, one of them that I see a lot is the expense ratio. For the regular person out there, we see it listed. We know that it's a cost, but dollar for dollar, I think it's hard for people to figure out how exactly that comes out of their funds.
Yeah, exactly. So what we do is part of our investment analysis, where we're going through looking at the funds you have, we're trying to figure out what their risk is, what their expense is, and if they're kicking out dividends. So one of the things we always educate on is expense ratios. And you need to understand that an expense ratio is a percentage of the dollars that you have in there that are going to go back to the mutual fund company. You're not getting advice. It's just to be at the party, I guess, is a way to tell. It's like a cover charge just to be there. You still got to buy drinks when you're inside. So when we look at this expense ratio, it's coming off, whether you're up or whether you're down. And what we try to look at is, are there funds that perform just as well that are less expensive? Because these fees, these expense ratios can be as low as 0 or 0.04%. I've seen as high as 2.5% on these things. So what that means is, if the mutual fund you had returned 4%, but you've got an exclusion ratio, or excuse me, we've got that expense ratio of 1%, you're getting a net 3. If you lose 4%, you're losing 4 plus 1.
Oh, wow. Wow. So even against what's happening in the fund itself, you can be trying to invest in it. So is there a range, a spectrum, where you like a good expense ratio?
We try to target under 50 basis points or under 0.5%. There's a few things that we use that are slightly higher, but those are actively managed by professional fund managers, and some of those they're providing something different. So again, pay for advice, not for other things. And what's interesting too, on the side note of just fees, when you think about mutual funds, they also have really weird rules around them. There's some regulations. There's a funky regulations with letters and numbers that was talking specifically about some mutual funds. Like, if it says it's a large cap mutual fund, then 80% of it has to stay in large cap mutual funds. Okay. So what that means is in 2008, 2020, when the market went down, the mutual fund had to stay 80% in equities. They couldn't make the changes inside because of a regulation. So there's some limiters to some of these things as well.
So if the market is going down, the funds themselves, even though they're actively managed, they have to stay in that exposure. And so they have to take that ride downwards. And you're paying for the privilege of that.
You get to pay for it. Thank you, sir. May I have another?
Yeah.
Absolutely.
So you do help evaluate for folks what kinds of funds they have, the expense ratio, and what it means to them financially.
Absolutely, we do that. And then one of the other things, I want you to know how things work. So if you're doing your job, if the portfolio manager is doing their job, if we're doing our job, we will rebalance. And rebalancing is just a way of adjusting how you're invested to match your risk tolerance to the current market and things like that. Because if we use risk as a measurement, we want to make sure that we're always there. Well, what's another fee that's not always spoken about is that certain custodians, so custodian is like where your money is. If you're working with an advisor, they don't have your money in the back room. It's at Charles Schwab, it's at Fidelity, it's at TD, right? It's at these places, they're custodians. Well, they actually have a trading fee on mutual funds. So there's like, it's not a commission, but in order to buy and sell a mutual fund at some places, it's up to $30 a trade. So that means if you are selling a mutual fund to buy another mutual fund, it's $60. And some portfolios that we run that people have might have 25 positions. If everything's getting rebalanced, it's 60 times 25. I'm not going to do the math for you right now, but
it's enough.
We're losing money just by having some of it managed. And sometimes it's hidden in wrap fees or things like that, but these are all costs associated.
So when you sit down with somebody, you can take a look to see the kinds of fund they're using, the kinds of expenses they have in there, whether they're working for them, whether they're working against them. And by the way, because I know folks can see it on the screen when it comes up at our commercial break, you'll actually do this review complimentary.
Yeah, we will do this complimentary. And, you know, tongue-in-cheek, I say you should pay for advice not to be in something. So if you have a mutual fund and you're paying to be in it with that ratio, that expense ratio, make sure you're getting something for it. Like if you're paying for something, you should be paying for like expert management, not just a set it and forget it portfolio. For us, what we're doing and offering to folks, if you have questions about what you're in, reach out and let's take a look at your investment statements. And we will look investment by investment, and we can tell you what's their risk, what's their expense, and we can figure out, is it working against you or is it working for you? It can be a scary situation. In fact, when we come back, I'll have another story for you about this.
Yeah. So we are going to take a break, and just one more thing on that. I think one thing that might put people at pause before trading out on what funds they have right now is to say, oh, there's going to be huge tax implications. Are there ways that you can be aware of that before you do the selling?
Yeah, again, depending on the account type you're in. So if you're in an IRA or you're just in a brokerage account, those are going to be taxed differently. There's no tax inside your IRA for moving mutual funds around. Every time you're buying and selling inside of your non-qualified, or your brokerage account, you have to be aware whether you have unrealized gains, because we want it, when you sell it, you're going to realize it. And onesie-twosie, it might not matter, but it can become taxable.
So you do want to be tax efficient. You want to make sure that you do it carefully. There are things to be aware of, but rather than facilitating on your own, they can call somebody like yourself. Corey, I've got to take a very quick break. Folks, if you want to make sure that you're using funds efficiently, that you're not paying too much in costs yourself, or basically, if you're unsure if you are, please give Corey and the team a call right here, 844-406-8011. We're going to continue to talk about funds and costs. Got to ask you about this word proprietary, and if you'll explain that for all of your viewers when we get back right after this break.
How confident are you in your current financial plan? Do you know with certainty how the recent market volatility will affect your future hopes and dreams? How much are you paying in taxes? And how much are you losing to unnecessary high fees? You didn't work to save this money so that you could spend your time worried in retirement. Now is the time to take charge of your finances so you can feel confident about your future. Call in during the next 30 minutes of today's show only to set up an absolutely complimentary, no obligation, full-blown financial review that will result in your own customized written plan that we're giving away complimentary to the first 10 people who respond. We'll start with a full-blown analysis of what you already have by running a report to untangle how much you are currently paying in fees, how you're allocated for risk, and what it's costing to work with your current advisor. Next, we'll identify your goals. Where do you see yourself in the next 5 years? Where do you want to go? And who do you hope to go there with? Is your current financial plan set up to get you there without mishap? Let's design a roadmap to create a financial plan you can follow with confidence. Get the piece that so many people are missing from their retirement. Find out how having a written plan can make a difference to your retirement dreams. Call now to schedule your complimentary, no-obligation, full-blown financial review today.
Welcome back to the Clear Path to Retirement with 𝗂𝗄𝗄. I'm your host, Spike Spangler. We want to make sure that you have a clear path to your retirement, and that's why Corey today is talking about some of those hidden fees, the kinds of things that happen in funds that are harder for regular folks like myself to kind of figure out and know exactly what we're spending.
Right.
You've said the word before to me, you said it again on the break, proprietary funds. And I guess it's like if you go into a store, let's say you go into a clothing store and they have their own brand of clothing or shoe. That's proprietary. You're buying what they want to sell. Of course, that store is going to be more motivated to sell their brand. Am I right?
You're exactly right. We see it every day in Target. We see it every day in Home Depot. It's not a bad thing, but they have their own brands, and it does go against some of the folks that they have on the shelf. And as independent financial advisors, what's nice is that we have access to whatever we want. Well, almost whatever we want. Sometimes not these proprietary things. And proprietary funds, there's nothing bad about them, but I want people to understand that there is some differences. So proprietary means like a bank or a brokerage firm has created their own mutual funds. All right, they're not going to a third party to create this. They have kind of not their own interest in mind, but they have a profit line that they're trying to consider. So I want people to understand if you're with a large firm that has offices.
Okay, let's be honest. Somebody who's big enough, they have big, huge commercials all over the place, the ones that you see during big sporting events. That's what you mean by a brokerage.
Yes.
So they can create their own fund, and then they have their own people managing those funds. So it kind of sounds like you're paying for them twice.
And they love that because, again, when you create a fund, of course, you have the client in mind and the chance of return, but you also have that money coming back to you, right, from that expense ratio.
Yeah.
And then what's interesting about some of these proprietary funds is their pricing might be a little different. And what I mean by pricing is that exclusion ratio. Or not, I keep saying exclusion ratio.
Expense ratio.
There's a lot of ERs in our business.
If it's confusing for you, imagine for them out there, it is confusing.
I know what I'm doing, but when we look at this, when we look at proprietary funds, we start to see they can be as low as 0.15%. There's a lot of good ones out there, but there are some that are substantially higher. In fact, I met with a gentleman last week, and we were doing a little bit of a review, and he had one account at a local bank. All right, they have their own kind of funds there, and he was in one. It had a cost of 1.3% built into it, and I said, "Did you know that it had this?" He said, "No, I didn't know. They didn't tell me what my expense ratio was." I got it right, what the expense ratio was in this fund. And again, they're not hiding, it's not bad, but you should know. I think that's the most important thing.
But that's the thing is, even when we go to buy a car, sometimes we don't know all of the right questions to ask. You go in there, you're looking at something, but then when you're going actually through that closing process, it takes you an hour or two, and there's this add-on or that add-on, but you don't know the questions to ask. And that's why we don't fault any of the viewers or anybody who comes into your office for the first time, is because they don't know the questions to ask. So when the person was at the bank, it's like, so what does it cost for me to work with you? Or by the way, is there a cost for this investment? Is there a cost for this solution? People need to know what those questions are.
They really do, and we have to be transparent. And as people who operate in a fiduciary capacity to people, that means that we are subject to the best interest. That means what is in your best interest. So when we're making decisions, we talk about education. We want you to understand, maybe not the nitty-gritty, but we want you to understand, here's what it costs inside of this, here's what it works, here's how it all works together, this is why we like it. We're trying to improve your situation. And it's a judgment-free zone when we come in. We are looking at you from today forward. Whatever you did that got you to us, whatever your situation is, it's yours. We will find a way to make it work. And I think that's really an important thing. So when we do sit down with folks and we do some of these things, we want to make sure that you feel comfortable and there's no judgment.
Right. So you have identified that maybe the costs are a little bit higher.
They can be.
Are they constructed just as well, such as diversification and exposure?
Sure, and we'll talk a little bit about diversification. They are structured very similarly, but what happens in some of these, if a third party that's out there creating a mutual fund, they might have 50, 150, 10,000 stocks inside of this mutual fund working to do something for you, or ETF or something like that. These There's a whole bunch of different types of funds. What we see a lot of the time is less funds inside, or less stocks, less options inside of the mutual fund. And that gets us to diversification. It's a word we hear a lot in finance. It's diversification. It means different things. The reason we want different is we want some going up and some going down. We don't want all of our money on this elevator, because when the cable falls, we want to be okay, right? So it's kind of figuring this out. So that's important to understand, that if they have less options inside of them, sometimes they may not be as diversified as you think.
Right. And then the other thing I do have to ask then, so I'm assuming if they're being sold in-house by a larger firm and so forth, there's probably incentives. You might have a manager who's trying to say, hey, you've got this S&P 500 fund, you got these 3 others, but this one is ours. If you guys are able to produce, many of these into the portfolios, you get this kickback or this bonus. Is that possible?
Yeah, I think a lot of times, and I can't speak to everybody, and I think there's a million advisors out there, and I think a lot of people are doing a wonderful job. So this is not levying any criticism on them. But if you work at McDonald's, you're selling McDonald's burgers, right? You're not selling Burger King burgers. So a lot of times what we see is that when people come from a certain place, we see the same funds, always. And it's always the proprietary funds. Again, it's not bad, but you should know that what they're selling you is theirs.
So can you explain to me a little bit more about independence? You are an independent firm, the ClearPath Wealth Advisors. What does that mean to viewers?
Yeah, so what that means is we choose. We have as many things as we have access to, we get to choose from. And I think that's important. It lets us be non-partial. If we see a handful of mutual funds and they're all returning the same, we can go look at which one has the least expense ratio. Right? That's the one for us. Or we can look at which manager that we like. And we're able to construct a portfolio for you that not only feels like you, but is working as efficiently as possible from expenses and taxes and all these other things. And that's a big part of our ClearPath to retirement process. It is this idea of how do we get rid of obstacles that are making you work too hard, your money work too hard, and their worry. It's not always worry-free, but we're trying to get as many of the things that we know out of the way.
Right. So you are the clear path to retirement here in the Twin Cities. And really for anyone here in the Minnesota area, you even said all the way down to Wisconsin.
Yeah,
sometimes you reach down
Wisconsin and Iowa. And the thing is, we live in a world now where we can meet through the screen. If you don't want to drive all the way up to us, everything's secure. So it's a wonderful opportunity to get a chance to offer planning and advice to people.
Right. So the Clear Path to Retirement review that you will do for folks, it is complimentary. Yes. They've got to reach out to you here. What are some of the bases you'll cover in that first meeting?
That first meeting, who are you? What are you going to do?
Hi, how are you?
Yeah,
Thank you for driving in.
We'll try to tell you who we are, but we want to know what are your sources for income. We want to know what are you spending money on? What does that look like in the future? Are there things going away? And then we do want to dig in a little bit and look at the puzzle pieces of your investments. What are you in? What's its job? How does it work for you? How do they work together? We overlay that with tax planning. We figure out, are things organized the right way? Should we change the risk in certain things? Can we make things work better together?
Right. Folks, if you would like your own complimentary review, your own clear path to your retirement, all you've got to do is call the phone number you see right here on the screen. As you can imagine, Corey is working a really large area around here. We're broadcasting all around the state. So call the number as soon as you can if you're worried about your own retirement planning needs. We're going to continue to talk about fees, making sure that the funds you're using are appropriate for you. But to make that appointment, call the number you see right here, 844-406-8011. More with Corey right after this.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Welcome back to your Clear Path to Retirement with 𝗂𝗄𝗄𝗃. He is one of the founders of the ClearPath Wealth Advisors right here in the Twin Cities. I'm your host, 𝘃𝗃, and today we're talking about the kinds of things that we want to be aware of inside the funds that we're using. They're going to get us through retirement. We're going to need these to last us for 20, 30 years, and those little tiny fees can eat away at us over time. So how am I supposed to know, how are the viewers supposed to know exactly what they've got as far as costs inside their investments?
Yeah, this is a really difficult thing because there's this huge world out there. One, how do I know what I'm in? So first you got to look at your statement. And if you want to know more about what you're in, there's a real simple solution. You can type in the ticker symbol, put a space, and put PDF after that. And what that's going to give you is something we call a tear sheet. And there is more information on there than you ever need to know. But it's going to tell you who the fund manager is, what their history is, what the idea behind the mutual fund is. Because most funds, they have an idea. Hey, we are searching for growth. We are searching for sustainable return. We are searching for, green energy, all kinds of different things. But the stuff that's the most important, though, because there's a bunch of really technical language. There's beta and all these alpha.
I was going to say the alpha, the beta, the vega, oh my. Do we have to be understanding all of these things to choose the right funds for our own retirement?
No, you don't. I don't think that's the things that really matter. I think the most important things to look at, so I will walk people through, not all the time. I do not want to spend my days in the weeds all the time. But I'll walk you through a statement, and I will show, or a tear sheet, and I will show you, I think one of the most important things is when people say I need to be more diversified. Well, a lot of these tear sheets have the number of holdings. And some mutual funds, I think I mentioned this before, have very few holdings. Some have quite a few. But what I'll do is sometimes I'll line up a handful of tear sheets. And we'll say, let's look at the top 10 holdings.
Okay. All right.
Same.
So we think that we're diversified by holding these different funds, but they're the same top holdings across the board.
Alphabet, Tesla, Amazon, Google, all of these things, we see those. Not everything. If it's a small cap fund, that means they have a smaller market cap. That's not going to be the case. But so many funds have the same things. And what we look at here is this idea of correlation. So there's diversification, which means things are going to go up and down. Correlation's kind of similar to that.
Okay.
And it's, boy, if this goes up, does this go down? And what we're trying to balance, and I'm probably going deeper in the weeds than we need to.
I would say with the correlation, there's the both. Are they correlated together, or do they have opposite correlation?
Exactly, and that's when you're constructing a portfolio, when you're putting things together. This is where an advisor comes in. What we're trying to do, and again, we look at risk. And this is, I think it's the most important part, because if there's an investment you have that you're uncomfortable with or you don't understand, my guess is it's outside of your risk tolerance. Now, it's okay if it's outside of your risk tolerance if we counteract that with things that are opposite of it, because we want risk where we need it. Mm-hmm. We don't want risk where we're going to rely on it, if that makes sense. So an example might be, if there's an account you're going to draw income from, we don't want that to fluctuate a lot.
Okay.
That should not be your most.
This might be for our retirees out there watching the program, this might be the one we're paying our monthly bills from.
Correct.
Our expenses, not necessarily the funds that we're saving for 5, 10, or 20 years down the road.
Correct. So we don't use a bucket strategy, but we use a bucket strategy. We want the income dollars to be the safest. And from there, we can pick riskiness based on taxation. So your non-qualified accounts, these are the accounts you would have written a check for to a brokerage firm or something like that. Only the gain is taxed, and only sometimes, because there's a long-term capital gains rates that I won't go into now, but we can manage that. So what we can do is we want that to be moderately or more aggressive to your situation. Then the money that you will hopefully never use, that you might pass on, well, shouldn't that be the one that's the riskiest? Shouldn't that be the one that's doing more for us? So even though I'm talking about it's difficult for you to find all the information as an individual or understand it or see what matters, checking in with an advisor who's offering a consultation or that's willing to help you and educate you, I want you to understand that you got to watch that it tells time. And if we need to, we can talk about a couple mechanisms inside of it.
Yeah.
But for the most part, is that one that fits like you. So that's
one quick point on that. You've said mutual funds a couple of times. Can I ask you about exchange-traded funds? Are you using that instead of? Because I think sometimes those do have a lower expense ratio.
Most of the portfolios we use are ETF, exchange-traded funds, because of a couple things. One, there's no trading fees on a lot of them. Two, mutual funds trade at the end of the day. ETFs, I think they're a little more, free verse. It's priced at the moment, which that's important too, when the world's changing really quickly and we're rebalancing. So we do like ETFs. They do the exact same thing. It's a group of investments inside of a package that have a common goal.
So clearly you understand all of this, but for the folks who are watching out there who say, I want to understand it, I just don't want to have to watch and manage it myself. You can go ahead and do this review. You'll take a look at their 401ks, 403bs, what's inside their plans. You'll be able to do a cost analysis for them and help explain exactly what's going on with what they hold now. Because those 401ks, they didn't have a lot of choices.
Correct.
They had the funds that were there. They might even have target date funds, which we didn't even cover today. We'll do that on another program. But you didn't have a lot of choice. Can you help people evaluate whether it's worth holding on to those or worth moving on to something else?
Yeah, that is a big part of our ClearPath retirement process. It's to walk you through all of these things. And I think what's really important is understanding that we're just showing you. We're not strong-arming you into making changes. We want you to understand what it looks like. And if we get to the point in our process after gathering the information we need and showing you kind of where you're at, we can agree to make a plan. That plan is our best effort to show you what we think could work. If there's parts you don't like, we can change. It's your money. We'll do what you want us to do with it, but we want to show you what we think is best. And I have to say I appreciate everybody who stuck along with us this ride today. It's been fun to talk about these things and connect with folks.
Yeah, I can tell that you enjoy it. Some people don't enjoy looking at it, or they get confused or overwhelmed, but I think you've been able to talk about it refreshingly, openly, so people can understand it, and that's exactly what you do in the office as well, offering people a clear path to retirement, not a confusing path, not one filled with fees and expense ratios that we don't understand, but in a way that you can explain it to folks.
Exactly.
So, folks, thank you so much, Corey, for doing this. I'm going to give them your complimentary review. Before you leave here today, folks, make sure that you get your own complimentary review. Call the phone number that you see right now. Don't just go on to the next program that's happening in a few moments. Call the phone number that you see right now so you can get your own complimentary review. Know the expenses that you have. These funds need to last all the way throughout your retirement years. Thank you so much for watching the Clear Path to Retirement with Corey 𝘳𝗓𝗍. I'm Spike Spangle, and we'll be back again more with your retirement needs next week.